Welcome back to Lamb's Cryptoverse. Remember, this presentation is not financial advice. We're here to educate you and entertain you. So let me ask you a question. What if I told you I had an indicator that predicted Bitcoin's recent top? You'd be like, wow, maybe I could use that, right? But why, you might be asking, why didn't I present this to you before? Well, the thing is, it's a new indicator, and I wanted to back test it and take a look at it. And it wasn't even for timing the market. Well, it was for timing the market, but not for timing crypto or equities in a near or intermediate term. It's more like a daily indicator. Let me tell you why I created it, and you'll understand more. When I was studying for the FRM exam, the Financial Risk Management exam, and some other exams in schooling, they showed that options was a great way for portfolio hedging. And we all heard of the term portfolio insurance. And one way of doing that is using options. Options are very popular. And there's also a famous book, I don't need to tell you, you probably all heard of The Black Swan. And in that book, Nassim Taleb spends a lot of time actually talking about turkey instead of swan. He talks about the turkey, how the turkey lives a great life, and because it's living a great life and it's eating well, it doesn't expect to get basically murdered and put on the dinner table for Thanksgiving. So he's talking about the unpredictability of things and the probabilities of black swan events. And he also talks about, or maybe implicitly, why you might need portfolio hedging. But he calls for a barbell approach, which is buying like lots of treasuries, right, for as a use for portfolio insurance. He's using instead of options. And he also calls for buying growth stocks. So growth stocks on one end and treasuries on the other end. And that's a big deal with the CFA exam or CFA Institute. They really love the barbell approach. But here's the deal. Empirical research showed this was not the case. And I even tested it with my own portfolio. Options is not easy to do and even more difficult to execute. And my other point I wanted to say is, let's say you don't buy put options to protect your portfolio. You do it in another way through an external source, like buying ETFs. And so there's an ETF, I put one example. Well, there's a few ETFs. One of them mimics hedge funds. That hasn't done well. There was another one called Flight to Safety, and it didn't attract any investors. They had to liquidate soon after they opened. What they did was buy gold, treasuries, and utility stocks. And I don't know, that doesn't work too well. As you could see with the recent market decline, gold stocks did not do too well. If the markets decline because treasury rates are going up, that means treasury prices declining. And so that flight to safety ETF may not work. And then there's the Cambria Tail Risk ETF. I'm a big fan of this guy that started this fund. I think his name is Meb Faber. But the thing is, and this is similar to my other point, what he does is he puts most of his money, this ETF money, into treasuries and then a little portion into puts. But it does not work. It works sometimes. It's like on and off. And what if the stock's declining because treasury prices are going down? Then the Cambria Tail Risk Fund would not do well. So when does it do well? And this goes to my last point. Portfolio insurance using options works best under periods of high volatility, and those periods of high volatility have to happen soon after you buy those put options. Because if it doesn't happen soon, those Greeks are going to work against you. And if you know your options theory, the Greeks consist of, the different type of inputs for the Black-Scholes model, for example. And in this case, one thing I want to highlight is theta. theta is very negative, right? So you get time decay when you buy put options. So that's why I created the daily indicator as an indicator, if you will, of what the market can do in a very near term. And here's the method behind the madness of my daily indicator. I'm not going to give you the inputs, but I'm going to give you some clues. The daily indicator looks at correlations, and I gave you some examples here. Like, what's investment grade debt doing versus equity? What's investment grade doing versus interest rates? Right? Investment grades for debt, for example, is supposed to go up in value when interest rates are declining. What's implied volatility doing? How's that acting versus other asset classes? So it's good, my next point here is that it's good if different asset classes move as expected. So you want high yield bonds rising with equities, especially the NASDAQ and risky stocks. So if risky stocks and Cathay Wood stocks are rising, you want to see high yield bonds rising. The same thing with treasuries. You want to see gold stocks rising and gold prices rising when treasury prices are rising. And even Bitcoin, you want to see Bitcoin rising in price when the S&P is rising in price, or even better, the NASDAQ is rising in price, or Cathay Wood stocks are rising in price. So you want to see those correlations. So what my indicator, and this is the last point here, my indicator indicates trouble when the correlations are not making sense. So here we are. This is a crazy chart. It looks like an echocardiogram, right? It goes up and down a lot. So what I did is I made a moving average, a 10-day moving average. So basically, I just want to point you to this purple line here. This is the moving average. So you want the line to be high. When it's at a high level, that's good, and when it's a low level, that's bad. And I've got in blue bullish and in red bearish. So I want to highlight to what the title of this presentation is, which is how I predicted Bitcoin's top and even the equity market top in November. And you can see here, I'm going to put my pointer on it. During November, the moving average moved into the red zone. So we actually moved below that red line. That's how I knew that the market, the equity market, and Bitcoin and cryptocurrency overall was at high risk. But again, I did not tell you guys about this because I don't have much data. I only have about 460 points of data. And to me, that's not enough data. I really like to, when I'm looking at charts, I like to go back many, many years, like at least a decade, at least over 10 years of data. And obviously, there wasn't even 10 years of data for the cryptocurrency market, or especially for social media, like tweets and Reddit. That didn't even exist, 10, 20 years ago. So I like to have lots of data because I like to do back testing, even more importantly, forward testing of data, which leads me towards my next slide. This is my takeaway. Number one, I would like to do more forward testing on this daily indicator before I can be confident on whether the readings are good or bad, whether they work or not. And there's also the need, as I said earlier, for back testing of data. But I'm not a big fan of back testing because you know what? Back testing doesn't work. There's survivorship bias, and you see that with the analysis of hedge fund data, right? All these hedge funds look good because what are we looking at? We're looking at the hedge funds that survived. When they don't perform, what happens? The hedge fund manager, the portfolio manager, closes that fund and just ends business, or maybe he or she starts a new fund under a different name. So I'm really worried about survivorship bias. And to be honest with you, I'm worried about bias overall. there's a lot of bias from just you being a human being. Anytime you're connected with something, anything, that creates bias. So you have to be really careful. There's also something called curve fitting, right? You fit the indicator to make it look good, or overfit. And thirdly, and there's many issues with backtesting, I'm just going to talk to you about one more, and that's that markets change and correlations change. And you see this a lot in the Forex market, meaning currencies. You have something called, I'm trying to remember the name. I can't remember the name right now, but it's basically that there's an input, a cause that affects a certain currency. So, for example, maybe the US dollar is going up, the dollar's strong because it's being jawboned. Basically, the US Treasury might be pushing up the dollar by speaking about it. Or maybe the US dollar is strong in the case that we have today because the Fed is increasing rates. Or maybe liquidity is getting very tight globally. And what's happening, there's a fight for the US dollar, so the US dollar is getting strong. But the thing is, these correlations change. For example, maybe because of all the debt that we're issuing, maybe S&P and Moody's downgrade the sovereign rating of the United States. So that would cause maybe a flight away from treasuries, right? Because the sovereign rating is declining and there's a credit risk for the United States. So there's a fluidity, there's a change in correlations that occur over time. And that's what I'm talking to you about, markets change. So when you backtest these data, the indicator going back 10 years, the markets change, and what caused the indicator to change in the past may not be what changes it in the future. So here's my conclusion. I'm still going to use the daily indicator. I'm still going to test it going forward, but it's to be determined. So we're going to use it as an input with our other indicators. We have many indicators. We have sentiment indicators, technical indicators. So I'm going to use it as part of my toolkit in terms of trying to predict whether or not Bitcoin could go up in price, decline, but I'm not going to be too confident or overly confident with this daily indicator. Well, thank you all for participating in this presentation, and please hit the subscribe and like buttons, and I'll see you soon. Bye-bye.